Hello students, welcome to BBA 432 International Business Management. Today I will cover chapter 9 which is about how the global foreign exchange markets operate. So we will talk about some of the characteristics of these markets and also define what foreign exchange is and who the major players are in the foreign exchange market. First, we will be talking about the major characteristics of the foreign exchange market, including the players in this market, and then later on we will compare and contrast different forms of exchange, such as spot, forward, options, and futures market. So here we continue with some of the learning objectives, such as explaining some of the major aspects of the foreign exchange markets. And also we will give some examples about how the companies use foreign exchange to facilitate international trade and finance. It's basically the price of a currency, specifically the number of units of one currency that buy one unit of another currency, right? So let's say if we look at the exchange rate between the dollar and the pound, you will be looking at, right, the number of units that 1 pound can buy with $1 of $1, right? So you'll be looking at the number of units that one currency can buy with 1 unit of another currency. In other words, you will be looking at how much money, how much pounds, in other words, can you buy with your $1, okay? So that number, of course, can change on a daily basis because exchange rates always fluctuate. The foreign exchange market is made up of many different players. Starting with the Bank for International Settlements, right? It's a financial organization which is centered in Basel, Switzerland. It's owned and controlled by 60 member central banks. So this market can be divided into 3 major categories: reporting dealers, other financial institutions, and non-financial institutions. So basically this consists of 3 major categories: reporting dealers, other financial institutions, right? Financial institutions other than banks, and non-financial institutions. So it's also important to summarize some of the major characteristics of the foreign exchange market, such as ways of trading and electronic means of trading the transactions, right? So dealers basically can trade foreign exchange either directly with customers or through voice brokers. They can also trade through electronic means, brokerage systems, or directly through interbanks. Okay? So again, as I said, there are different ways in which dealers can trade foreign exchange. Directly with customers, through voice brokers, through electronic means, brokerage systems, or directly through interbanks. Recently, more than 50% of foreign exchange trading volume was being executed by electronic means. indicating that electronic means has become a very prevalent way of trading in the foreign exchange market. The trend is really going in the direction of electronic transactions. The foreign exchange market has two major segments, as you guys can see on the slide here: over-the-counter market and exchange traded market. It has two major segments, OTC and ETM. The OTC market is composed of commercial banks, as just described, investment banks, and other financial institutions. Those are the key players in the over-the-counter market. The exchange-traded market comprises securities exchanges, such as the CME Group, NASDAQ, and Intercontinental Exchange, ICE, where certain types of foreign exchange instruments, such as futures and options, are traded. So if we look at the global over-the-counter foreign exchange instruments, you will see a number of instruments being traded in the foreign exchange market, starting with the spot transactions. Spot transactions involve the exchange of currency for delivery in 2 business days, the day the transaction was made. So in other words, the currency has to be delivered in 2 days, the day transaction was made. For instance, a bank would quote an exchange rate for a transaction on Monday, but the delivery would take place on Thursday. The rate at which the transaction is settled is called the spot rate. So if you look at the outright forward transactions, right, involve the exchange of currency on a future date beyond 2 business days. So this is not like immediate delivery or a short delivery in 2 business days, right? This is not a short delivery. This is a delivery on a future date beyond 2 business days. It is a single purchase or sale of a currency for future delivery. The rate at which the transaction is settled is the forward rate and is a contract rate between the 2 parties. The forward transaction will be settled at the forward rate no matter what the actual spot rate is at the time of settlement. So basically in forward transactions, what really matters is the forward rate, right? The forward rate, not the actual spot rate at the time of the settlement. In the case of FX swap, in the case of swap, one currency is traded for another on one day and then swapped back later, right? So one currency is traded for another on one day and then swapped back later. Most often, the first or the short leg of an FX swap is a spot transaction, and the second or long leg is a forward transaction. Let's give an example. For instance, let's say IBM receives a dividend in British pounds from its subsidiary in the United Kingdom, right? But has no use for British pounds until it has to pay a UK supplier in 30 days. It would rather have dollars now than hold on to the pounds for a month, right? Therefore, IBM could enter into a FX swap agreement in which it sells the pounds for dollars to a dealer in the spot market at the spot rate and agrees to buy pounds for dollars from the dealer in 30 days at the forward rate. Now let's look at the currency swap deal. The currency swap deal, most of the currency swaps, they deal with interest-bearing financial instruments, such as bonds, right? Bonds are interest-paying financial instruments, right? Whoever was the bondholder receives an interest on the bond paid by either the corporation or by the government, right? So therefore, in the case of currency swaps, they deal more with interest-bearing financial instruments and involve the exchange of principal and interest payments. We're really talking about payments on the bonds here. Options, basically, option instruments are the right, but not the obligation to trade foreign currency in the future. On the other hand, a futures contract is an agreement between two parties to buy or sell a particular currency at a particular price on a particular future date, as specified in a standardized contract to all participants in a currency futures exchange, rather than in the over-the-counter market. So US dollar is the most important currency on the foreign exchange market. In the latest BIS survey, the researchers, the surveyors, found that it was one side, buy or sell, of 87% of all foreign transactions worldwide. 80% of all foreign currency transactions worldwide involved the trading of dollars. So therefore, as you can imagine, dollar is an investment currency. It's a key, the dominant investment currency in many capital markets. Reasons for the use of US dollar. There are a number of reasons why dollar is the main currency in the foreign exchange market. Here are some of the most important reasons. Number one, dollar is a reserve currency held by many central banks. It's a transaction currency in many international commodity markets, like commodity trading such as oil or the agricultural goods are traded in dollars. Therefore, dollar is a transaction currency, right? It is an invoice currency in many contracts. It's an invoice, meaning that many contractual agreements are entered using the dollar as a currency. It is an intervention currency, right? We call it as an intervention currency, employed by monetary authorities in market operations to influence their own exchange rates, right? Most of the time, the Federal Reserve uses the dollar, right, in its market operations to influence, either to decrease or increase the value of their own exchange rates. Okay? London, of course, is an important trading center because of the geographic location and the time zone, right? If the US dollar is the most widely traded currency in the world, then why is London so important as a trading center, right? So this is the most important issue that we need to answer, the question that we need to be able to answer, right? We said that dollar is the most widely used currency, but then why is London one of the most important or the important trading center in the world, right? There are two major reasons of that, two major reasons. First, London is very close to the major capital markets in Europe, right? So it's a strong international financial center where many domestic and foreign financial institutions operate. Thus, its geographic location relative to significant global economic activity is the key reason of why London is so important as a trading center, right? Second, the second reason, London is positioned in a unique way because of its time zone. So you can also see in the map 9.1 in the book, you will see that. So you will see that in that map 9.1, for instance, noon in London is 7 a.m. in New York and evening in Asia. So this is a very unique way. London is very uniquely positioned because of its time zone. As London is 7 a.m. in New York, noon in London is 7 a.m. in New York, and evening in Asia, right? So the London market, in other words, opens toward the end of the trading day in Asia, right? And is going strong as the New York foreign exchange market opens up. Okay? Thus, the city straddles both of the other major world financial markets. Here in the figure, you can see the geographical distribution of the foreign exchange markets, United Kingdom, because United Kingdom's distribution here is responsible for 40.9% of foreign exchange trading in the global economy, followed by the United States, which is 18.9%. Okay, so this sort of like shows the importance of London as the center of global foreign exchange, followed by the United States and other foreign exchange markets in different parts of the world. Okay, and then our learning objective 3 has been to compare and contrast spot, forward, options, and future markets. So as I said before, the spot market is for foreign exchange transactions that occur within 2 business days. Those transactions has to occur within a short period of time, such as 2 business days. So in these transactions, rates are always quoted by the foreign exchange dealers. The bid rate, in other words, if we talk about the bid rate is also known as the buy rate. It's known as the buy rate, right? It is the price at which the dealer is willing to buy foreign currency, right? It is the rate at which the dealer buys the foreign currency. The offer is the sell side, right? The bid is the buy side. The offer is the sell side of the market. The offer, in other words, is the price at which the dealer is willing to sell a foreign currency. That's why we call the offer price as the sell price, because it is the price that the dealer, at which the dealer sells the foreign currency. The difference between the bid and the offer rates is the dealer's profit margin. Okay? It is the dealer's profit margin. And direct and indirect quotes. Okay, so let's define the direct and indirect quotes. So by looking at an example of how a bid and the offer rates might work. Okay, we talk about the bid and the offer rates, right? For example, the rate a US-based dealer quoted for the British pound on April 1st, 2016 was 1.4 to 30. Okay? So this means the dealer is willing to buy pounds at 1.4 each and sell them for 1.4 each. Okay? So this means is that the dealer willing to buy the pound at $1.4 each and sell them for $1.4 each. So this is also known as buying low and selling high. In this example, of course, the dealer quotes the foreign currency as the number of US dollars for 1 unit of that currency. This method of quoting exchange rate is called the direct quote, which is the number of units of the domestic currency for 1 unit of the foreign currency. It is also known as American terms. Okay? The other convention for quoting foreign exchange is known as the indirect quote, right? Or it is also known as European terms. So direct quote is known as American terms, indirect quote is known as European terms. This time, this refers to the number of units of the foreign currency for 1 unit of the domestic currency. Okay? There are also something known as base and term currencies. So when dealers quote currencies to their customers, they always quote the base currency. The base currency is the denominator. The base currency is the denominator. So the dealers will always quote the base currency, the denominator first, followed by the terms currency, the numerator. Okay, so we have the base currency versus the terms currency. The base currency is always the denominator, whereas the terms currency is the numerator. Like the example that I gave while I was discussing the direct and indirect quote. For instance, I gave the example of, for instance, the rate a US-based dealer quoted for the British pound on April 2016 was $1.4 divided by 30. 1.4, right, denominator, whereas 30 numerator. Okay? So let's talk a little bit about the forward options and future markets. So as we noted earlier, the spot market is for foreign exchange transactions that occur within 2 business days. But in some transactions, a seller, for instance, extends credit to the buyer for a longer period, for a period much longer than 2 days, for instance. For example, think about a transaction between a Japanese and the United States. Let's say a Japanese exporter of consumer electronics might sell TV sets to a US importer with immediate delivery, but payment in 30 days. So they deliver the goods immediately, but they will make the payment will come in 30 days in the forward market. Therefore, the US importer is obligated to pay in yen in 30 days and may enter into a contract with a currency dealer to deliver the yen at a forward rate, right? The rate quoted today for future delivery. So this is called a forward market, okay? Because transactions occur in a period much longer than 2 days. Okay? So building on what we said earlier, we can now say that the difference between the spot and the forward rates is either the forward discount or the forward premium. On the other hand, option is the right, but not the obligation, to buy or sell a foreign currency within a certain time period or on a specific date at a specific exchange rate. A foreign currency, let's say a foreign currency future contracts resembles a forward contract insofar as it specifies an exchange rate sometime in advance of the actual exchange of currency. However, a future is traded on an exchange. These future instruments are traded on an exchange, not on OTC or over-the-counter market. Instead of working with a bank or other financial institution, companies work with exchange brokers when purchasing futures contracts. Okay? Don't forget, future contracts are always traded on organized exchanges, not on over-the-counter derivatives or over-the-counter market. Okay? Also, let's look at some of the major aspects of the foreign exchange markets. For instance, when a company sells goods or services to a foreign customer and receives the foreign currency in return, it needs to convert it into the domestic currency, right? So when importing, the company needs to convert domestic to foreign currency to pay the foreign supplier. This type of conversion usually takes place between the company and its bank. At one time, only the big money center banks could deal directly in foreign exchange. Regional banks had to rely on them to execute trades on behalf of their clients. The emergence of electronic trading has changed since then. So here are some of the top organized exchange markets for foreign transactions. So we start with the CME Group. The CME Group was formed on July 2007 as a merger between the Chicago Mercantile Exchange and the Chicago Board of Trade. The CME operates according to so-called open outcry. So in other words, traders stand in a pit and call out prices and quantities. The platform is also linked to an electronic trading platform, which has grown rapidly over the years. NASDAQ, let's look at NASDAQ. Prior to 2008, the Philadelphia Stock Exchange was one of the pioneers in trading currency options, right? In July 2008, PHLX, meaning the Philadelphia Stock Exchange, merged with NASDAQ. And in 2014, its name changed to NASDAQ. NASDAQ trades options in 7 currencies: the Australian dollar, the British pound, the Canadian dollar, the euro, the Swiss franc, the New Zealand dollar, and the Japanese yen. The final organized exchange that we will be talking about is the New York Stock Exchange. New York Stock Exchange, ICE. In 2013, there was Intercontinental Exchange, ICE, purchased NYSE Euronext, forming NYSE IC. Okay, so this was sort of like a merger transaction which was ICE, between ICE and the NYSE Euronext, forming the NYSE IC. The combined company is a giant in futures and options. Okay, ICE Futures US offers cross trades in a number of currencies through ICE's futures contracts on key currency pairs traded in the interbank market through electronic trading platform. Here is the foreign exchange trading process, providing us with a visual presentation, right? So as you can see, this figure visually shows the trading process for foreign exchange. Between a US company, you see the flow of transactions from the US company to financial institutions, to brokers, and how the brokers are carrying out those transactions, meaning options, futures, and exchange, and how this whole network of transactions is linked to money center banks and other financial institutions. You can clearly see here the network of players basically operating in the foreign exchange markets. Okay, basically today we talk about how the foreign exchange markets operate, the key players in the foreign exchange markets, and different financial instruments of trading, right? And how we also discuss how the companies used foreign exchange markets to facilitate international trade, but also make profit through speculation and arbitrage. So this was a small chapter. We will continue our discussion with global investment markets in the next chapter. Thanks to my listening to my lecture so far, and I will see you in the next chapter soon. Have a good night. Bye-bye. Bye-bye.